What is money flow index divergence, and how do you use it to find a trend? Money flow index divergence measures the difference between the price and the relative strength index. Money flow index indicates the momentum in a trend, and it changes from a negative to a positive divergence. Understanding money flow index divergence. Money flow index divergence is a concept in technical analysis that alerts you to a potential trend reversal. There are a few different types of divergence, but the one we'll focus on is what's called negative divergence. Negative divergence occurs when the current money flow index reading, or momentum, is lower than the prior reading. If the divergence is negative and the market is trending up, then traders can expect a downwards trend for this particular asset. Confirming the money flow index divergence. A popular strategy among traders is to measure the relative strength index, money flow index, in order to help determine when a stock is overbought or oversold. If a money flow index diverges from price, it can signal a change in trend. The money flow index compares closing prices with the highs and lows of the day, giving it a value between 0 and 100. Traders watch for a divergence where a stock's price continues to go up but the money flow index heads down. Understanding the money flow index divergence pattern. Money flow index divergence is the difference between the money flow index values over time. The money flow index value moves up and down due to price movements. If price increases, and the money flow index will rise because more buyers are entering the market. The divergence occurs and the money flow index has a lower value. This signal can be seen as a trend reversal, but it is still volatile, trading divergence. In the previous Forex education sector, we introduced the relative strength index, money flow index, as well as the buy and sell function as it reestablishes the overconsumption and overconsumption signal. In this section, we go beyond the basics and introduce a more complex concept, divergence. The multiplication occurs when the Forex currency pair reaches a new high or low, and the signal, in this case money flow index, is not confirmed. This is a 4-hour GBP/USD chart showing both bullish and bearish money flow index movements. Bullish divergence occurs when price hits new levels and the money flow index crosses the low. On the other hand, divergence decline occurs when the price reaches new highs, but the money flow index stays at the same level as the previous high. We marked bullish, buy, signals in green and bearish, sell, signals in red. The buy, green, signal exceeds 200 pips before the fundamentally overbought cross for currency trading disappears. Notice some lull between this output and the retrograde fall signal. This trend has not yet taken hold, but the currency pair has already dropped to 90 points. Let's take a closer look. Note that if the money flow index returns above 30 red crosses, it leaves 3 major buy signals before a bearish bullish signal arrives. The first two are pretty awful. GBP/USD fell more than 250 pips before finally recovering. The third sign is relatively better. The pair only rallies 115 pips before the reversal. On the other hand, a bullish-bearish signal matches the currency itself perfectly. There is only one major sell signal for a bearish split. GBP/USD is priced at 50 pips from the high, not as bad as false buy signals, but there is always room for improvement. This time the down signal does not match the peak perfectly, but the difference is very small, about 5 pips. Downside, a trader looking to divergence is likely to avoid some trading losses and enter the market at a better price than your underlying money flow index trade. This provides more secret saves and easier goals, and should also lead to a better win rate. Money flow index often precedes price action. This means that the money flow index often starts to rise/fall before the price. This can give the Forex trader a profitable start from your average price movement when trading Forex. What is my cash flow index, and how do you use it? The cash flow index, MFI, is a technical oscillator that uses price and volume data to determine if an asset is overvalued or overvalued. It can also be used to spot differences and alert you to changes in price movements. The oscillator ranges from 0 to 100. Unlike traditional oscillators such as the Relative Strength Index, RSI, the Cash Flow Index contains data on both price and volume, not just price. For this reason, some analysts call the MFI RSI for weight loss. What does the Cash Flow Index tell you? One of the most important uses of the Cash Flow Index is through diversification. Multiplication is when the oscillator moves the other way towards the price. This is an indicator of a possible reversal of the normal price movement. For example, a very high cash flow index that starts to dip below 80 as the underlying continues to rally, indicating a reversal in the price range. On the contrary, the value of the MFI is very low, over 20, while the underlying asset is always sold as a sign of a price change. Traders also deal with large differences with different price waves and MFIs. For example, the maximum stock price is $10, then the price drops to $8, and then increases to $12. The price reaches two consecutive highs, $10 and $12. Doesn't confirm the new high. This may indicate a decline in prices. Overtime and oversold levels are also used to identify trading opportunities. Movements less than 10 and more than 90 are very rare. Traders see the MFI move above 10 to signal a long trade and fall below 90 to signal a short trade. Other movements in the overbought or oversold zone may help. For example, if assets are in an uptrend, they may fall below 20, or even 30, and then rise higher, indicating that the pullback is over and the uptrend has resumed. It looks like a downtrend. A short-term rally could push the MFI towards 70 or 80, but if it goes down, it might be time to go short in anticipation of a pullback. New swing trading strategies. Momentum traders can use the bullish money flow index to their advantage. So for today, we'll look at how a move in price and price can tell you about a move direction. That's for sure if you know what to do with the goose when you have it. The market then made another pull of the 20 EMA again and created another bullish engulfing candlestick. The market then pulled back to the 20 EMA and created a bullish engulfing candlestick. As you can see, the market has been in a strong uptrend and trading above the 20 EMA. As you can see on the left side of the chart, the market has been moving down, making rates low. You would be in a better position to use this Forex Dive Money Flow Indexification trading strategy on a demo account. A demo account allows a beginner trader to develop the ability to detect bullish and bearish patterns, as well as find Dive Money Flow Indexification arrangements. You can open a free demo trading account in less than 5 minutes. To determine the money flow index variance, look at whether the price is creating different high/low levels of the money flow index oscillator. It is best to apply support/resistance levels, other technical indicators that predict market reversal, candlestick and card patterns. Sometimes the reversal happens with a single candle. Sometimes you need to see real prevention and correction to prove it. The basic money flow index indicators relate to the position of the money flow index line compared to 3 areas of the signal. Trading involves great risk and there is always potential for loss. Think about the broad work you should do looking for a bullish money flow index dive on a 15-minute chart on all major crossovers. Finding a bullish divish money flow index is simple. You just need to apply a relative strength index signal in the graph and analyze its movement relative to the price. In the simplest definition, there is variance when there is a discrepancy between a technical signal such as money flow index and price. All you have to do is apply a signal and make sure the price and the signal are moving in different directions. A bullish dive money flow indexification is the first sign of a possible price reversal. However, you always need additional confirmation, whether it is a MACD, money flow index or stochastic oscillator signal. Then, you should hold the trade for as long as the price action allows you or until you see the opposite money flow index signal. After you have determined the difference, you must be present that there is a reversal of price reversal. So, wait for the start of the reversal for a higher accuracy trading position. The real strength chart is a momentum oscillator used to give trading signals based on overbought/oversold levels, crossovers, and divergence. A stochastic oscillator is used by technical analysts to measure movement based on asset price history. Class B bearish divergences are shown by prices making a double top, with an oscillator detecting a lower peak. The other name for the positive money flow index split is just bullish diving. It usually means that the bearish move is at its end and it is very likely that the price will start to rise. Advanced Money Flow Index Dive Money Flow Indexification will give you a good opportunity to trade the market in a bullish direction. In contrast, the Money Flow Index is a better alternative to identify hidden divergence. This is true because the Money Flow Index is a trend following a signal. Some technical indicators can be placed directly on the price chart or in a separate window, usually below. For this introductory stimulus, we don't need to look at candlestick patterns. And as you can see, the first entry method has the highest risk-to-reward ratio, followed by the second entry method, then the third entry method. As for the stop loss, it is placed below the low level of the bullish candlestick bar. The last entry method is the most conservative of the three methods. In the bull case shown below, the money flow index needs to create higher levels while the price achieves lower levels. In this case, the price climbed nearly 5% after the bullish divide created in the daily chart. A good place for your stop-loss order is the edge created at the time of the price reversal. If it is a bullish divergence, you are looking to place the stop-loss order below the base that the price creates at the time of the reversal. The money flow index signal can also help traders to see bullish hidden spots. Comparing the swing movements in the price with the swing movements printed on the money flow index oscillator, a bullish hidden multiplier develops on the price chart. A bearish divergence is indicated when an overbought reading of the money flow index signal and a lower high is correlated with higher highs in price action. Continuing analysis of many financial instruments draws a lot of lines of movement that will cost you a lot of time. This analysis applies to any technical oscillator and is widely used by traders. We examine the highs and lows of closing prices, linked to the new highs and lows of the money flow index. In this tutorial, we'll show you a simple new method that allows you to automatically identify differences. You will not have to draw dozens of lines of motion by hand to find any signs. To make the signal more meaningful, you can use abstract moving averages, or you can shorten the moving average times. But, if you prefer to be short like me, seeing divergence in a case like this is money in the bank. If you find yourself wanting to put a trade to the far side when the price is going up but the money flow index or MACD agrees, it's hard not to. It measures at a percentage from 0 to 100 and is an advantage and you don't see a clear movement in a company's stock. In most cases, this would be a stock that trades horizontally or either side. By definition, money flow index is the average gain of downtime during a given period divided by the average downtime loss. This indicates weakness in price action and is a bearish signal. In the chart above, you can see that prices are making prices higher and money flow index making prices higher. In the chart above, you can see that the prices are making higher low and money flow index making lower low. When prices are making lows higher and money flow index making lows low, we have a bullish hidden divide instead. A bullish divide occurs in an uptrend and prices continue to rise to the upside. A steady bearish breakdown occurs and we have a discrepancy between rising prices and a falling technical signal. Consistent bullish dive money flow indexification occurs and we have a discrepancy between falling prices and a rising technical signal. As you have noticed, dive money flow indexification is not a technical indicator per se, but it is a trading concept. There is no mathematical formula for measuring multiplication, but they are visual tools on the price chart. In trading, dive money flow indexification occurs and the price of an asset and the signal you are looking at move in the opposite direction. In other words, when the price of an asset is out of sync with the readings of the corresponding signal, a dip signal occurs. This can be cited as an example of a strong bullish pattern. But money flow index is making levels higher. If you are a new trader, you should always keep this page close to you to help identify the patterns correctly. The same strategy can be applied to the mobile average travel signal. The money flow index is a single line that fluctuates between an overbought, oversold, and neutral area. So, as the price and signal take a bullish form, there is a sign that the price will rise soon. In addition, there is a bullish crossover, which means we can open a long position. Money flow index is an oscillator that is commonly used to show an oversupply/oversupply market position. Difference between cash flow index and relative strength index, RSI. The MFI and the IRS are closely related. The main difference is that MFIs contain volume, while RSI does not. Measurement analysts consider this to be an important indicator. Therefore, they also believe that MFIs will detect and potentially prevent reversals faster than RSI. One indicator is not better than the other, only they contain different elements, so signals are sent at different times. MFI cash flow index limits can give false signals. This is when a signal does something that indicates a good trading opportunity, but the price does not move as expected, resulting in a trade loss. For example, a refund should not result in a price change. A sign cannot alert you to what is important. For example, diversification sometimes results in prices, but variation is not present in all price ranges. For this reason, traders are encouraged to use alternative risk analysis and control methods instead of relying on a single signal.